Okay, so you are welcome once again to our class. And this evening we are having financial management, and we'll be looking at investment appraiser. In our last lecture, we have been looking at investment appraiser, particularly looking at the NPV method of assessing investment, and also internal rate of return in assessing investment. We have considered the effect of inflation and also taxation when it comes to appraising various investments that are undertaken by companies. All right, so today we want to look at lease or buy decision. And if time permits, we also look at the asset replacement decisions. So these are the last aspect of investment appraiser that we're going to look at in terms of our financial management treatment of investment appraiser. As we have already said, we said investments should always be undertaken when it leads to an increase in the shareholders' wealth. So it is the same assumption that we are holding. Now, lease or buy decisions, there are two key decisions that we will be looking at when it comes to lease or buy decisions. These two decisions are the acquisition or investment decision and then the financing decision. So to make a lease or buy decision, an entity would have first of all need to consider whether the investment it is considering has a positive NPV. Is it worth investing in that project? So the first step of lease or buy decision is to undertake the acquisition or investment decision. Then subsequently, when the investment decision has been positive and the company would undertake that investment, then it will go ahead to look at the financing decision as to whether it should buy that particular asset, for example, or invest funds directly, or consider a lease option. Usually, when we are looking at lease or buy decision, it has to do with an asset, investing in an asset. So these are two key decisions that we have to assess this evening. Now, when we are looking at NPV techniques for the first decision, which is the acquisition or investment decision, we want to look at the key considerations that goes into the acquisition or investment decision. Normally, when we are looking at investment decision, the cash flows that we consider, we use the normal NPV techniques as we have previously considered. And then the cash flow covers the cost of the asset, which is the purchase cost of the asset. Then we look at the benefits and costs from the project. As we have already looked at, there are instances where they will give you the benefits and also cost of the project, and therefore you need to consider the benefits and also subtract the cost to get you the net cash flow. So those are important things that you need to consider. It's the same principle that applies to investment decision in lease or buy decision. Then we also would consider the residual value of the asset. As you are aware, in our previous consideration, we said that the residual value of an asset should be considered at the year in which the asset or the residual value of the asset will be disposed of. So we are looking at the proceeds that will be realized from the disposal of residual value of the asset. So in the year in which that sale is made, we will consider the proceeds from the residual value of the asset. That's the inflow as part of the investment cash flow. Then we also look at tax cash flows. Tax cash flows. There are two key things that we look at. We said that there are two methods. In our previous treatment, we look at two methods. We look at the capital allowance approach, where we subtract the capital allowance, we determine the tax, and then we proceed to determine the cash flows. And then the other approach is where we look at the tax relief that will be enjoyed on the capital allowance vis-a-vis the tax that will be paid. So those are the two considerations we did in our previous decisions. So when you are looking at the investment decision, all these are factors that you need to take into account in the investment decision as we have previously considered. Note that usually the cost of capital is equal to the company's after tax cost of capital. So please take note of that. And in our previous discussion, we look at the WACC, where financing is from various sources, for example, from equity and also debt. And so we need to determine the weighted average cost of capital. And please note that since we are considering tax, it means that the cash flows that we will arrive at will be after tax costs or after tax cash flows. And therefore, the cost of capital that should be applied to appraising the project should be the after tax cost of capital. So these are considerations that you have to take into account when you are looking at the investment decision of the cash flows. Now, when it comes to the financing decision, the cash flows, I've already mentioned that the financing decision is based on the investment decision. Based on the investment decision, when the NPV is positive, then the financing decision will be considered. That is, should we consider buying the asset outright, or should we lease the asset? So when we are looking at the financing decision, we are always looking at the financing cost from the perspective of the lower or the lowest PV of cost. The lower or the lowest PV of cost, in which case we would have to consider the cost of buying the asset by looking at their present value. So we look at the buying of the asset. If we are buying the asset, we look at the present value of the purchase price of the asset. Or if we are borrowing to buy the asset, the present value of the funds that is borrowed. Then we will look at the tax savings on capital allowance, which will be an inflow. So usually the cost of asset or the purchase price of the asset will usually be an outflow because we are buying the asset and the money is going out. Then the tax savings on capital allowance will be an inflow. So we usually also determine that, and then we juxtapose that against that of the cost of the assets. And so we will get a certain present value of cost. Then we will also look at that of leasing of the asset. Leasing of an asset also can come with capital allowance, but you have to note that under the leasing of an asset, it is only the lessor who enjoys capital allowance, but the lessee does not enjoy capital allowance. And therefore, when we are considering leasing of an asset, we look at the lease rental payment, which will be the cost, which will be discounted to their present values. And then we look at the tax relief on lease rentals. So those are the two things that we consider when we are looking at leasing of an asset. We will discount them to their present value, and then we get a certain cost of the asset. The financing decision is that we are looking at the lower or lowest of PV of cost. So when you discount the cost in relation to buying of the assets and then the cost in relation to leasing the asset, you compare the two and determine which one is the lowest, and that will be the financing option. So when it comes to lease or buy decisions, these are the two key decisions that you consider: investing decision and also financing decision. All right, so note that we are still reminding you, when you want to make a decision, implementation of project should be for project with positive NPV, and that project should lead to increase in shareholders' wealth. We have already considered this one. So now let's quickly consider our practice question. So we'll look at this question, and then we will probably would end here today, and then consider the asset replacement cost at another time. So let's look at this question, practice question 1. management of MPAC or EMP Limited are considering.
I'm not seeing.
You are not seeing the
question.
Are you seeing the question?
No.
But the previous slides, you saw them.
It's just the investment decision cash flow that is here.
So you saw that you guys saw the financing decision cash flows.
No.
You are not seeing the financing decision cash flows.
No.
What about the NPV and shareholders wealth maximization?
No. It's just the investment decision that is on the screen right now.
Okay. So let's look at. So I've already explained the financing decision. So we are looking at the question, the practice question. So the practice question, we're looking at management of EMP Limited are considering an expansion project which entails an immediate investment of 5 million in a machine. The project useful life is 4 years with nil residual values. The machine's cash operating surpluses each year is 2 million Ghana cedis. Tax allowable depreciation is 15% on straight line basis, whilst corporate annual tax rate is at 30%. The company is considering an outright purchase of the assets or leasing it at a cost of 1.8 million each year in arrears. The cost of financing the project is 20% required should the project be accepted for implementation, and 2, what mode of financing is acceptable for this project? So this is the question that we are considering. So as usual, we will consider it from the Excel perspective. Note that our consideration from the Excel perspective is usually not applying the Excel formula computation, because in an examination you may be looking at how it is worked on the exam booklet. That's how we want to approach it in this solution. All right. All right. So let's consider. Sorry, this is a wrong spreadsheet. Okay, so now let's proceed to our spreadsheets. All right, so we're looking at, so the two decisions, we're looking at the investment decision and then also the financing decision. So let's first of all consider the investment decision. So before you consider the financing decision, you need to look at the investment decision. All right. So the facts of so we are looking at EMP Limited, and we are looking at project expansion. Project expansion. So the key thing we are looking at is lease or buy decision. All right, so these are the things that we're looking at. Now we look at the facts of the question. So the facts. So we have project cost. We are looking at machine. So machine cost. Machine cost is how much? 5 million cedis. It is 5 million cedis. So 5 million Ghana cedis. That's the machine cost. All right. We have also been given the lifespan of the project. So first, also we have also been given cash operating surpluses. So cash operating surpluses, and that is 2 million each year. So yearly. Then we have the lifespan, project lifespan, or we have the lease renter. So lease renter is also at 1.8 million yearly. Then we have been given the project lifespan as, so lifespan of project is 4 years. So it's 4 years. We have been given the tax allowable depreciation. So tax allowable depreciation, which is capital allowance at a rate of 15%. So 15%, and it is on straight line basis. Then we have also been given the corporate tax rate. So corporate tax rate, which is at the rate of 30%. So 30%. We have the cost of capital. So cost of capital. That's after tax cost of capital. The tax cost of capital of 20%. So these are the facts of the question, and we have been asked to determine whether the project should be accepted for implementation, and 2, what financing mode is acceptable for the project. So this is the question that we have been given. So in the first place, we need to determine the viability of the investment. And having determined the viability of the investment, we will now consider the financing mode that is acceptable for the project. Okay, so now we have all the facts that we need here on the spreadsheet. So what we'll do is that we would lower this one and then consider the spreadsheet. All right. Okay. So let's expand our spreadsheet and then look at it here. All right. So this is what we have. Let's increase the font size and then we consider this. All right. So we are looking at lease or buy decision. So the first decision we need to consider, as I've already told you, is to consider the investment decision, which we have already looked at. So the first issue, the question demanded of us is the investment decision. So that's what we are considering Now, investment decision. Okay, so we are looking at the investment decision. All right. So investment decision, we have to appraise the project. So here we will have the year of the project, which is so we will have the time, which is here. Time. We have the we also have the initial costs. So initial costs, or what we call the capital outlay, the initial cost of the project. Then we have the operating benefits. So operating surpluses. Operating surpluses. So that's there. So if you have the operating surpluses, we will now have our tax and tax reliefs. So we have taxation and then tax relief. Tax relief. So tax relief. Now, when we get our tax relief, we get the project cash flow. So project cash flow will be here. So net project cash flow. Net project cash flow. All right. So when we get our net project cash flow, we get our discount factor. Discount factor, in which case we have been given the cost of capital, after tax cost of capital at 20%. And then we have the present values of the project. So this is what we are looking at. This is what we are looking at. All right. So let's quickly look at them one after the other, and then we would consider. So the project has a lifespan of 4 years. So we start from year 0, 1, 2, 2, 3, and 4. Note that in this question, we were not told that the tax is payable in arrears or half is paid in the year of incident and subsequently the other half is paid in the following year. So since we are not being told of any such thing, we consider the tax as being paid in the year in which the tax is occurring. So that is how we would consider our taxation in this question. All right. Okay, so we look at the project cash flow, which is 5 million here, 5 million Ghana cedis, which is here. So 5 million. All right. So project cash flow is 5 million. Don't forget that it is minus. So minus.
Yes.
We can look at it in terms of this one because it is minus. Let me see. Do I have any? Well, I don't have any minus something here. So we consider it like that. It's minus. Now we have the yearly operating cash flow as 2 million Ghana cedis. So 2 million Ghana cedis. So we fill it down. 2 million Ghana cedis. All right. So 2 million cedis yearly cash flow. Right. Yearly cash flow. So let's write it here. All right. Then we need to determine our tax. Now we are told that the tax is on capital allowance. The tax that's supposed to be paid is on capital allowance. So taxation, we have the tax reliefs, and then we also look at the tax relief on capital allowance. So we consider our taxation on the operating surpluses. Then we will consider our tax relief. All right. Note that our tax has been given as a rate of 30%. So 30%. So tax is on operating surpluses. Tax relief is on capital allowance. Then when it comes to the tax relief, we have been told that it is around 15% of the capital allowance. So we also look at that one. All right. So let's look at our capital allowance workings. Let's do some workings here. So we are looking at our capital note 1. So note 1, we are looking at capital allowance. All right. So we are told that the capital allowance is on straight line method. So we have the cost of machine, and the cost of machine is 5 million Ghana cedis. 5 million Ghana cedis. So it's 5 million Ghana cedis. So capital allowance is 15%, or capital allowance is 15% each year. So capital allowance is determined as 15% of the cost. So this one is equal to this times that. So that gives us the capital allowance. Now we look at the tax relief. So tax relief is 30% of tax relief. Tax relief is 30% of the capital allowance. So here, please, we have determined that the tax relief is 30% of the capital allowance. So here we are going to get 30% times the capital allowance, and that gives us 225,000 Ghana cedis. So when we go here, we calculate our tax, which is 30% times the surplus, which is that, operating surplus, which is that, and it will be the same every year. Then we have, so note that tax is negative, so we put negative in front of it. Tax is negative. So note that tax is payment, so it's an outflow. So we put negative in front of it. Then the relief is positive. So each year we have a tax relief of 225,000. All right. So note that we were not told that the tax is paid 1 year in arrears. So we assume that it is paid in the same year that it occurred. We have not been told that way. All right.
Oh, okay.
So we now look at our net cash flow. So cash flow, net cash flow. But my thinking is this: even though we are not told that the tax is paid 1 year in arrears, we all know that this year's tax will be paid in the following year, isn't it?
Yes.
So even though we are not told in the question, my thinking is to assume that it is paid 1 year in arrears in normal practice. But if we have not been told in the question, I may decide to treat it this way and state my assumption for treating the tax this way. So my assumption is that I am assuming the tax is paid in the year in which it occurs. That's why I put it this way. So in which case, when we get our net cash our net project cash flow, we would be summing all the cash flows up. So here we have that up to here, and we get that. So it's negative 5,000. Then we come here, and we get these ones. So our discount factor is the cost of capital. That is after cost of capital, after tax cost of capital. Now we have to discount it. So here we have 1 divided by 1 plus 0.2 to the power of the time, which is this one. So I have to do to the power of the time here. So that gives us 1. Then we drag it down. In exams, that's how you have to do it. So you get your discount factor. Then you multiply your discount factor by your net project cash flow, as we already know. So we have all that. Okay, so this is it. After that, we just sum the PVs up. That's the present value of the cash flows up, and we'll get our NPV. In this project, we are getting a negative NPV, of 793,000. So NPV of 793,000. Okay, so what will be your decision?
If it's a negative NPV, then we shouldn't consider.
Okay, so since this project has a negative NPV, then the decision is that the project investment should not be considered. So
Yes.
that will be the decision. So investment decision. This project has a negative NPV of 793,306 Ghana cedis. A negative NPV of 700 and should not be considered for investment. Okay, so this is our investment decision. So you do this. Now, in a normal practice, the investment decision is done this way. So you determine whether the project is viable. So you may decide, in fact, in this case, since the project is negative, has a negative NPV, then we should not consider investing in it. So that is that. But in this question, we have been asked 2 questions. First, we should assess the investment decision. Should we invest? Our decision is that it has negative NPV, so we should not invest. Then it's an exam, so we need to go ahead and also look at the cost financing bit, the financing of the project. We need to look at that one too. So in this case, we are going to look at the financing decision. So here we are looking at the financing decision. So financing decision, we are going to look at the 2 options. So first, we look at it the same way as we have looked at this. So we'll pick the project costs for the buying side. So here, financing decision, there are 2 options we are looking at. So we are looking at I. So assuming buying the machine. So buying the machine. So if you are buying the machine, what will be the cost consideration? We have said that you are looking at just the cost. So you look at the cost of the project and you look at the tax savings in terms of the tax reliefs that you will get, as well as the savings So tax relief. Tax relief is the same as the savings that we are talking about. I've already mentioned. So you look at those two considerations and determine whether the project should be invested in or otherwise. So that is that. So first, you need to consider one, buying the decision, the NPV of the cost implication, and also if you are leasing, what will be the NPV of the cost implication. So now we have already determined the cost of capital and the tax relief. So the tax relief of the project will be how much? Hello?
Right.
What will be the tax relief?
225,000.
So 225,000. So in which case we are looking at the tax relief. This one here. So we'll bring that one to here. All right. So we now determine the net cost of the project. So we sum this one up, and we are going to get, okay, it's supposed to be here. We sum this one up. So this is what we get. All right. So we get this one here. And then we do our discount factor, which we have already also done here. Discount factor, and then the PVs. So discount factor and the PVs. So here, our discount factor is that. So we are looking at this. We are discounting it at 30%. So if you look at this one, you see that the project's cost will be PV of cost will be 4.4 million. So we have the capital allowance.
Negative.
Yes, what are you saying?
It's negative 4 points.
So yes, that's the cost. So we are looking at the PVs of the cost. We are looking at the present value of the cost in those two scenarios. So the first scenario, if you are buying and we are looking at the present value of the cost, we will have to look at it as 4.4 million. Then we look at the second option, which is the buying. So which is the leasing. So when we are leasing, what will also be the consideration? In which case, we are looking at leasing the asset. So leasing the machine. So when we are looking at leasing the machine, what are some of the considerations we will look at? Yes. Hello.
Hello, sir.
Yes. So if you are leasing the machine, what are some of the considerations we will look at?
The time, the initial cost.
So here we are leasing the machine. When we are doing the presentation, we said we have the rental payment. So we have the rental payment, and that will be the cost. And the rental payment, we were told that here, if you come here, we said the lease rental is 1.8, but in the question, we were told that it will be in arrears, yearly in arrears. So if it will be yearly in arrears, how many rental payments are we going to do?
5 years.
Are we going to do 3 years, or we are going to do 5 years?
5 years.
Why 5 years?
Because the last this one will enter into the 5th year.
The last is going to be what?
It's going to enter into the next year, so it will be 5.
Okay, so the last is going to enter into the
Next year,
so,
following year.
so it's going to be what? 5 years. What if it was
Yes.
in advance?
In advance will be 3 years.
It will be how many?
3 years.
3 years.
Yes.
Okay. So why are you saying that if it is in advance, it will be 3 years, but if it is in arrears, it will be 5 years?
So like in advance is maybe it's prepaid. So you paid let's take 2020. So they paid for 2020 amount in 2019.
Okay. So this is what? So
Yes.
if it is in advance, you pay for 4 years. You pay it at the end of each year. But if it's in arrears, you pay it. You start from year 0, year 1, year 2, and year 3. So that's how it will be paid. So in this
So
case, we are looking at 4 years as the 4 years as the consideration that we are looking. So here, year 1, we have negative 1.8 million. So 1.8 million. Then up to year 4. Now we are saying that the release will be on this rental payment. It won't be on capital allowance. It will be on this rental payment. The relief will be on this rental payment. So that is how it will be. So here we are going to calculate 30% times this one. And this one should be that. So relief should be 30% of that. The percentage did not come. Okay. So here that will be the relief. So you see that at the end you are going to have the PV of the lease option to be 3.2 million. Are we fine?
5.
So what will
Please,
happen here?
hello.
Yes, I'm listening.
I'm saying that so you calculated 30%, so and then it still indicates that there are 16%.
You said here I calculated.
No, they're leasing the machine. Yes, after the rental payment.
Here
Hey.
I'm saying that here the release, the tax release is
30%.
on is 30%
Yeah.
on the lease rental payment. That is what you enjoy as tax relief. But in the buying the machine, you enjoy a tax release of 30% on the 30% on the capital allowance. So here is net cost. So net cost. All right, then we have PV of cost. So this is what we do. So what will be the decision?
Say.
Yes, what will be the decision? Assuming the project has turned out to be has a positive NPV at the onset, what will be the decision? What will be the decision? Which will be the financing decision? Should we lease or should we buy?
We should buy.
Why should we buy? If you are buying, the cost is 4.4. If you are leasing, the cost is 3.2. So should we lease or should we buy?
We should lease the machine.
We should lease. We should go for leasing option. So the financing decision should be a leasing of the machine. machine, since it offers a lower cost of 3,261,806. So this will be the financing decision. So this is how we look at make or buy. First, you need to look at the investment decision. If the project is positive, you now proceed to look at the financing decision of buying the machine or leasing the machine. You look at which one has the lowest present value of cost. And then in this situation, assuming the project had a positive NPV, then would have gone for leasing